Hey everybody, Joe here from Avalon. As a first-time homebuyer in Canada, saving up for a down payment on a house can be a daunting task. Thankfully, there are some tools out there that can help you save that money for your first home purchase. In this video, I'll be talking about the newest registered investment account that's offered in Canada, the First Home Savings Account, or the FHSA. I'll explain everything you need to know about the FHSA and how it works. You'll find out who is eligible for it, the benefits of using it, how to contribute and withdraw funds, and some potential pitfalls to avoid. So all that and nothing else coming right up. The FHSA has the word savings in it, but it's actually a registered investment account. Usually when you earn income on investments that you hold, you have to pay income tax on that investment income. However, there are some registered investment accounts that provide tax benefits, and the FHSA is the latest of these accounts. It combines some of the benefits of the tax-free savings account, the TFSA, and some of the benefits of the Registered Retirement Savings Plan, the RRSP. The FHSA allows you to reduce your taxable income and also grow your money tax-free, as long as the money is used to buy a home. I like to think of the FHSA as a big bucket that you can dump your cash into. The cash can then be used to purchase various types of investments, but it's all done inside of that bucket. For example, let's say that you took out $1,000 and dumped it into your FHSA bucket. The bucket now has $1,000 of cash sitting in it. You have now contributed that money into the registered account, and you get to deduct that amount from your income in the current year, reducing your income tax. You could then use that cash to purchase investments of various types. Let's say that you purchased a guaranteed income certificate, or GIC, worth $1,000. The investment is still held within the FHSA bucket, but the cash has been replaced by the GIC. As the GIC earns investment income, that money stays within the FHSA bucket, and you get to earn that income tax-free. In the future, when you're ready to buy your first home and pull that money out, you don't have to pay taxes on that money. However, if you take the money out and don't use it to buy a house, you would then have to pay taxes on the money that you earned. This is because you didn't use the funds for buying a home, which is what the account is designed for. To wrap up this section, let's look at a simple summary of how your first home savings account works. You contribute cash and get to deduct that amount from your current taxable income. You invest that cash and the income is earned tax-free inside the FHSA. If you withdraw the cash to purchase your qualifying home, you don't have to pay tax on the money that you withdraw. If you withdraw the money and don't purchase a house, you'll have to pay tax on the amount that you withdrew. Next up, we'll look at who is eligible to open a first home savings account. To open an FHSA, you must be between the ages of 18 and 71, a Canadian resident, and you must also be a qualified first-time homebuyer. Now, the term first-time homebuyer shouldn't be taken literally. It doesn't necessarily mean that you have never purchased a home in your lifetime. It means that in the last 5 calendar years, you did not live in a house that you or your spouse or common law partner owned. So if you live with your spouse in a house that they own, you aren't able to open an FHSA, even if you've never actually bought a property yourself. But on the flip side, if you do own a house as a rental property and you've never lived in it, then you could open an account. The First Home Savings Account is also designed with specific timeframes for its use. You can have your FHSA open for 15 years after the year that you open the account. So, for example, if you're 30 years old, when you open the account, you have until you're 45 to use that money in the account to buy a qualifying home. So the FHSA can remain open for up to 15 years or until the end of the year that you turn 71, whichever comes first. If you don't use the money within your FHSA to buy a home within the 15 years, or by the time you turn 71, you have a few options. You can withdraw the money and pay taxes on it, or potentially better option would be to transfer that money into your Registered Retirement Savings Plan, or RSP, or a Registered Retirement Income Fund, RRIF, on a tax-deferred basis. This could help maintain the tax-free growth of the funds as they would still be held within a registered account. The FHSA, like the TFSA and RRSP, has an annual contribution limit. The FHSA's limit is $8,000. There is also a lifetime contribution limit of $40,000. The lifetime contribution limit was chosen as it represents about 5 to 6% of the average home price in Canada, which is also roughly the minimum down payment for a house under $1 million. On a yearly basis, starting in 2023, you can fund the account with up to $8,000. Any unused portions of that limit will carry forward up to a maximum of $8,000 to use in the following year. So I'll give you a few examples to clarify what these contribution limits mean and how they work. In the first example, you contribute the maximum amount of $8,000 in 2023. Then you continue contributing the annual maximum $8,000 each year for the next 5 years. By 2027, you've hit your maximum of $40,000 in total contributions. That's the basic example of how you would maximize your contributions as quickly as possible. Now let's get into the carry forward contribution room and how it works. Let's say that in 2023, you only contribute $2,000, leaving $6,000 worth of carry forward room. Then in 2024, you get a bunch of cash and you decide that you would like to contribute as much as possible. You're able to contribute the full $8,000 for 2024 plus the prior year's carry forward contribution room of $6,000. So in 2024, you get to contribute a total of $14,000. Then we'll say you weren't able to contribute any money in 2025 or 2026. Now the year is 2027 and you want to contribute as much as possible again. You missed contributing $8,000 in both 2025 and 2026. But in 2027, you're only able to contribute $16,000. That's $8,000 from 2027's contribution room, plus the $8,000 that was carried forward from the year before. That's because the $8,000 is your maximum carry forward contribution. Clear? Now that we know about the contribution limits, you might be wondering what happens if you contribute more than $8,000 in a year or over $40,000 in total. Well, if you go over your limit, you'll have to pay a 1% penalty of your over contribution for each month that the excess amount remains in your account. So it's very important to keep track of how much you're putting into that account. What kinds of investments can you hold within your FHSA account? The answer is that you can hold the same types of investments as in your TFSA or RSP. That is stocks, bonds, mutual funds, exchange traded funds or ETFs, or guaranteed investment certificates, GICs. If you're curious about where you can open an FHSA, don't worry, we have you covered there too. You can open first home savings accounts at most financial institutions in Canada. This includes most credit unions, online brokerages, and any of the big banks, including TD Bank.
TD Bank?
You might do a little shopping around to see if anyone is offering a promotion to open your account with them. Or you might go ahead and stick with your current financial institution because of their great customer service. The FHSA was designed so that the $40,000 plan limit could cover the down payment at 5% for the average home in Canada. However, that doesn't completely help people in markets like Toronto, Vancouver, or even here in Victoria. Thankfully, you can combine the use of your FHSA with the RSP Home Buyers Plan during the purchase of your qualifying home. The Home Buyers Plan, or HBP, is a program offered by the Canadian government that allows first-time home buyers to withdraw up to $35,000 from their RSP tax-free to use towards the purchase of a home. The withdrawal amount is considered a loan and must be repaid to your RSP over a period of 15 years. You will need to start repaying that borrowed money to your RSP after 2 years, and you'll find the required payments on your notice of assessment each year. So while the FHSA might seem like a great idea, it's also important to consider the potential downsides. For example, let's consider the rapid growth of housing prices in Canada. If housing prices continue to grow faster than your investment return, you might not be gaining much ground in your quest to buy a home. Also, you're locking up your money for a specific purpose. If your plans change and you decide not to buy a house, or if you're unable to buy a house within the 15-year time limit or by the age of 71, you won't be able to take advantage of the tax-free benefits of the FHSA. That being said, the FHSA is still another potentially useful tool for Canadians looking to save up for their first home. Just make sure that you understand all the ins and outs of the FHSA before deciding if it's the right move for you. There you have it, our rundown of the First Home Savings Account, a unique savings vehicle that combines some of the benefits of a tax-free savings account, TFSA, and a registered retirement savings plan, or RSP. It's another, albeit small, step towards helping hopeful Canadian home buyers with their currently expensive and challenging situation. If you enjoyed this video or found it helpful at all, please hit that like button and consider subscribing. That means that more of our videos get shown to more people and lets us help more people. And it's also a lot of fun to see. So thanks for watching, and we'll see you in the next video. Cheers.